On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. A question that's coming through thick and fast these days is, have US stocks got too expensive and are they in a bubble? Well, it certainly has been a fantastic run for the US share market. The S&P 500 index is up 18% over the last 12 months, and it's up 83% over the past 3 years. Even Federal Reserve Chair Jerome Powell has commented on this, noting that equity prices are fairly highly valued. He said that during a recent speech. To be fair, he was responding to a question, rather than feeling the need to proactively offer an opinion on the US market. For the record, I don't believe that US stocks are in a bubble. I do, however, agree that they're looking pricey. That means investors do need to tread carefully and think a little bit harder about how they spread their equity exposures. Valuations for the US market are at the highest levels we've seen for some time. The widely used price-earnings ratio, PE ratio for short, is sitting at 22.8. Now that's well above the average since 1990 of 16.6 and 18.7 over the last 10 years. The only time in recent history it's been more expensive was back in the late 1990s, in the days that preceded the dot-com boom and bust. Things are eerily similar today, with the market strength being largely driven by companies associated with AI, artificial intelligence trends. The big three, Nvidia, Microsoft and Apple, together make up more than 1/5 of the S&P 500 index. Last month, Deutsche Bank produced a fascinating chart to really put this into perspective. It showed how Nvidia's market value had surpassed the total value of every country in the world's entire listed stock exchange, apart from the US, China, Japan, and India. Let that sink in. One company, Nvidia, is more valuable than all the listed companies in Canada, or in the UK, or in Germany. The US market is certainly more concentrated than we've seen in decades, and while that's a risk, it also makes those PE comparisons a little less useful. The tech giants of 2025 have increasingly dominant positions, high margins, and very profitable business models. Can you really compare them with the biggest companies of 2 decades ago? Back in 2005, ExxonMobil was the largest stock on the market, while Citigroup, General Electric, and Walmart were in the top 5. The earnings power of this class of 2025 is hugely exciting, especially if you're a believer in the productivity growth potential of AI. Now, it can't be overstated how important this is, because it's earnings growth that ultimately drives share prices, at least in the longer term. Earnings growth for the US tech sector was up 23% in the June quarter, relative to a year earlier. The communication services sector, and that's where the likes of Meta and Alphabet reside, saw an even larger gain of 46%. Looking ahead to next year, 2026, analysts are projecting earnings growth for the S&P 500 index in its entirety of almost 14%, which is double the long-term average of about 7%. Now, the so-called Magnificent Seven is expected to contribute as much as 2/3 of this. Even if those earnings tailwinds can justify the higher valuations, and even if they do keep pushing the US market higher, there's a strong case for diversification right now. Other share markets around the world look much more reasonable when we compare current PE ratios to the 25-year average. The UK and Europe are trading in line with history. Emerging market shares are only slightly more expensive, while Japan actually looks a little bit cheaper than history. Even within the US itself, there are sectors which have lagged and look better value. Healthcare, energy, and real estate are trading in line with their longer term average PE, while utilities and consumer staples are only at a modest premium. Now, each of those regions and US sectors will be facing its own unique backdrop, and valuation alone isn't an indicator of where prices will go over the next year or two. However, for investors that are feeling a little uneasy about the ongoing strength of American equities, there are plenty of ways to hedge your bets. Valuations across the US share market are indeed high, but it could keep performing well if the economy remains resilient, the Fed keeps reducing interest rates, and if the tech sector keeps delivering solid earnings. At the same time, it would be unwise to ignore the risk that things are getting a little bit overdone, at least in the short term. I think the astute investors out there are probably making sure that they have an exposure to markets outside the US while maintaining a healthy foothold in the world's biggest economy. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.